Welcome to Real Estate at Work. So Dave is VP of Data for BiggerPockets. He hosts a super relevant podcast called On the Market. And if you haven't subscribed to it, go on YouTube right now and subscribe. It's called On the Market. They literally break down all the crazy headlines and trends so that investors can make more well-informed decisions when buying real estate, where to invest, markets, asset classes. It's pretty cool. And honestly, I am so grateful that Dave agreed to come on the show all the way from Amsterdam, because Dave, how late is it for you?
It's 11 p.m., but it's my pleasure to be here. Thank you.
Oh, so sweet. So here's a fun fact. When Dave's not analyzing data, he's indulging in the best sandwiches that the country has to offer. And hence he calls himself the Data Deli. So
it's my real passion, but unfortunately in Amsterdam, the sandwiches and deli culture just doesn't stack up.
Oh, okay then. Here's a cheeky question for you. It actually came from one of our audience members.
Great.
If Denver real estate market was a sandwich, which one would it be?
Oh my God. It would be like a classic Italian sandwich. It's a little bit fancy. It's a little bit expensive because you got all those different meats and stuff going on, but it's not like extremely bougie and like the most high end. There's no foie gras or anything on it, but it's a nice high end sandwich that is very reliable and you'll be happy with.
I love it. Okay. That's perfect.
No one has ever asked me to combine my two passions like that before. That's a first for me.
I know. So the audience actually put out a bunch of questions that they wanted to ask you. And I saw this. I was like, this is brilliant. This is what a good question. I want to hear. Yeah, this is a great question. We have a couple different surprises for you. So really excited for today's show. We're going to hear from a killer finance content creator. Never had one of those before on the show. So I am so excited because he is such a crazy, trendy inspiration. All right, Dave Meyer, welcome to the show. Let me spotlight you first.
Ooh, fancy. Well, thank you so much. It's a pleasure to be here. I'm really grateful to speak with all you today.
Okay, so if you can break down for us what is happening in the market today, just give us an overview. That would be amazing.
Like actually today?
Like today.
Sure,
What's
yeah.
trending today, Dave? What is trending today?
So you probably have all heard, but the Federal Reserve raised their federal funds target rate today by 75 basis points, which is just a fancy way of saying 0.75%. And that is the largest increase the Fed has ever had in their interest rate since 1994. So this is pretty significant in terms of the strength of the action they're taking to combat inflation. Now, a couple months ago, it would be pretty unheard of or unexpected to see a rate hike of this magnitude. But as of last Friday, when the May inflation data, the consumer price index data came out, it was much higher than expected. Back in April, things were starting to look a little bit better. May, things really were pretty ugly last week. So it became a bit more apparent that the Fed was going to do something like this. And of course, that has huge implications for the entire economy, for both equities markets, cryptocurrency, real estate. But I'll stop there because that's basically what happened today. Is they announced this really big interest rate hike and gave some forward guidance as well as where they think interest rates are going to be at the end of this year and over the next several years.
So what does that guidance look like? What did they say about where it can be?
So I'm still digesting it, but I think it said that it was going to, by the end of the year, they're expecting the federal funds rate, which if you're not familiar is not mortgage rates. It's basically the lowest interest rate in the entire economy. It's what banks sort of borrow from the Fed at or borrow from each other at. And they think that could reach about 3 and 3/8, so 3.375 by the end of the year, and then expect next year that it could go up to about 3.25. So they're seeing very rapid interest rate hikes, but by towards the end of through the end of this year, and continued interest rates hike into 2023, but at a much slower pace.
Wow. Okay. So some say that this is the crash of the housing market that we're all waiting for, because honestly it was so out of whack. But others say that there won't be a crash. And where do you stand with all of this?
Well, part of my job at BiggerPockets is speaking to economists, and I am not an economist, so I should caveat everything I say here is just my opinion, and I just do my best to understand what's going on. And, I've interviewed two very prominent real estate economists in the last 2 days. One of them says there will definitely be a crash, and one of them said there will definitely not be a crash. So that just shows you the variety of opinions and the lack of precedence in this type of economic environment. Personally, I try to look at I try not to look at it in that stark terms, like there is a crash, there's not going to be a crash, and try and look at individual elements of the housing market and how they're sitting today. And right now, I think there is overwhelming, the media talks a lot about a lot of different factors that genuinely put downward pressure on the housing market. And I think that's a really important thing here, is to think about things as pressure. Like, interest rates are not the be all end all of the economy or of the housing market. They play a huge factor in the housing market, but when they go up, that doesn't necessarily mean it's not a one-to-one relationship with housing prices going down. And I think that's a thing a lot of people say. It's like every time interest rates rise, housing prices crash. That's not true, but it does put downward pressure and on housing prices. So that is all true. And I genuinely believe that we are seeing a lot of forces that are putting downward pressure on the housing market, namely interest rates hike, with prices at so high, affordability is just extremely low. And with inflation, people's budgets are getting really stretched. So they're less of their income can go towards shelter because it's going towards gas or food or whatever else. On the other hand, there is a very strong force putting upward pressure on the housing market, which is extremely low inventory. And this is something that has been on a downward trend for generations, and is extremely low in historical terms right now. And so I personally view this sort of as a tug of war, right? There's like affordability putting downward pressure. There's low inventory, which puts upward pressure. And it's just sort of this balance. And so the way it's trending right now is that I believe demand is going to soften. We're going to see that affordability becomes a bigger and bigger issue. People are going to pull out of the market, and that is going to greatly moderate prices in the housing market. Now, when I say moderate, I think that means returning to somewhere in the much more closer to historical levels. So that could be as high as, let's say, 3 or 5% appreciation rates, or as low as -5 or perhaps even -10. I personally, on a national basis, don't see the market going down more than 5 or 10% in really, at least today, even with rising interest rates. But I think there are certainly markets that certain individual markets that will go down more than 10%. Overall, I really think what we're going to see is a housing market that gets a lot more stuck, right? I think like some markets will be down a little bit, some might keep growing, but overall prices are going to stay relatively similar for the next year or two, is kind of the way I'm reading the data, at least right now.
So some amount of stagnation.
I think so. I really just think the amount of homes that are going to be sold are going to plummet. I don't think people want to sell right now. And I don't think we're going to have a lot of volume in the market. And that's probably going to lead to a decent amount of, just like stagnation in the housing market a bit.
So I'm in the Seattle market, and we have lost 50% of our buyers just from, going from May to June. And that's because our inventory has also gone up, by 30%. So buyers just have a lot more to choose from. And I also do think that it's just a matter of time. Like people have to wrap their mind around what's going on to be able to make more informed decisions. And this is that time where people are just holding off, sitting on the sidelines to see what is going to happen. So when you and I spoke a couple of weeks ago, you spoke about like historical performance of the housing market during a recession. I'm not saying that we're in a recession, but like in the past when we were in a recession, what did that look like?
Sure. Yeah. So over the last several decades, let's say like since the 70s, it's been like 6 recessions. 4 of them, housing prices actually went up. And of course, everyone remembers in 2008 because that recession was so severe, and it wasn't a typical recession because the housing market caused the recession. It wasn't like there was a recession and that caused housing prices to go down. Housing prices tanked and that caused a recession. And I know it's like a little technicality, but I do believe that's an important distinction because a lot of times in history, you see that housing prices don't go down. Now, on the other hand, we've never seen a period of appreciation like we've seen over the last 2 years. So we're also in unprecedented territory here. But it is not a given that in a recession that housing prices go down. A lot of times you see people just hold on to their houses. And especially from an investor standpoint, you also don't really see rent prices go down in a recession, just generally speaking. So it's not a given. And I think that, of course, everyone wants certainty, but that does just add to the number of things that are uncertain right now. But I do think it would be wise to assume that depreciation is not going to happen for the next couple of years, like whether that goes down or if it's relatively flat or if it's slow growth. As an investor myself, and what I say to other investors is like, over the last few years, I have sort of been vocal about people who say like, don't invest for appreciation. Over the last 5 years, I think it was a great time to invest for appreciation based on macroeconomic conditions then. Now, I think that's completely changed. And while I don't personally believe there's going to be this like nationwide housing crash, I do think in pockets they will decline. And generally speaking, you're not going to generate a good return from market appreciation.
Got it. So let's talk about that a little bit. In this kind of environment, right? One of the most common questions I got from the audience was, what is a good strategy to invest?
Great. Yeah, I love that. So there's a few that I can think of. One is house hacking. I don't know how much you talk about that here, but if you're a beginner investor, house hacking, I actually just built a Excel calculator that shows, because everyone talks about like buying versus renting and what's better, but like there's a third option, which is house hacking, and it generally is better a lot of the time. So I think in most markets and in most market conditions, house hacking is always a good strategy. It saves you money, even if you're not cash flowing. If you're reducing your your shelter expenses, like that is a positive benefit for your financial position. So I think that's really good. It also teaches you a lot about investing, which is great. The second like big category I would say is just value add. This is a time-tested strategy from investors, but if you can find properties that are not valued properly or need a lot of work, and you're not going to find a lot of people who want to take on that kind of project, that always works. If you can find off-market deals or even on-market deals that are a little bit hairy, they're going to require a little bit of extra legwork, excuse me. Then I think that's a really good strategy. I live in Amsterdam, so I do a good deal of syndication investing, like large multifamily, mostly value add investing as well there, which I think is still a good strategy. And while I don't necessarily think returns are going to be as easy to come by as they have been over the last decade, I genuinely believe that real estate over the next 10 years is still going to offer outsized returns over other asset classes. And so I continue to invest because I think there's risk in the market, but there's risk in doing nothing with inflation as high as it is right now. So those are just some high level thoughts on strategies. I'm not a house flipper, and I am not going to start in this kind of environment. But I think there are plenty of other strategies that work well.
So let's talk about some of those other assets, stocks and crypto. Can you give us like an overview of what's going on with those assets?
Sure. Yeah. It's not like crypto is definitely not my area of expertise. I do invest in cryptocurrency, but I don't claim to understand the fundamentals of the crypto market very well. I do invest in stocks, but I'm not picking stocks. I am pretty boring in that regard. But I'll just say that basically people are fleeing from speculative assets, it seems like. The Fed has indicated very strongly today that they're going to do whatever it takes to get inflation under control. That means that they are going to almost deliberately break the economy, right? Like they raise interest rates to lower demand. That lowers demand at the consumer level. Less people are going to buy homes. They're not going to take out loans to buy cars, and businesses are not going to, hire more people, expand, build a new factory, whatever it is. So that they're basically telling us that they're willing to send the country into a recession. And as an investor, they're looking at that and saying that corporate earnings are probably could go down, which lowers the value of stocks. And with inflation so high, the actual real value, like the inflation adjusted value of corporate earnings, is declining. And so people are generally just trying to get out of these more speculative assets like tech stocks where they don't have a lot of revenue, or some like SPACs aren't even profitable. And they're trying to get into either raise cash and sit on the sidelines, or get into more time-tested, recession-resistant stocks like energy stocks, for example. And I also just think like over the last few years, stock valuations reached a really high rate. A PE ratio is a common way of measuring how stocks are valued. And it was, the S&P was up to about 37%, or 37, sorry, not percent. And the historical is about 18. So like over the last few years, we've seen stocks valued really high, and they're still above the historical average. So it's not like stocks are at this like crazy valuation low now. They were at a crazy valuation high before. And again, this is just like the Fed has been injecting money into the economy for 2 years. So we saw artificially inflated asset prices in the stock and crypto markets, and now people are just like going back to normal almost. And so it is shocking and jarring, but at least in my opinion, not altogether unexpected, given that last 2 years have just been sort of a free for all, and now we're getting back to like a much more sober approach to asset valuations.
Yeah. In looking at percentage of home buyers today, how many of those are your retail home buyers, and how many of those are investors?
So, yeah, so there are various estimates about this, but I think the idea that investors are running the housing market is greatly overstated about.
Thank you. Yes.
Even the high estimates, it's about 20% investors. So I think that obviously has an impact on the market. And the thing about investor activity is that it tends to be hyper localized in certain markets or submarkets. So if you're in Charlotte, or Atlanta, then you do feel the impact of investors in a very real way. On a national basis, is that what's causing prices to go up? No.
Yeah. I can't wait to dig into basically what markets to invest in, and then how you analyze different data to come up with these findings. There's so many questions I have around that one topic, and we're going to get to it, but we want to give you like a 5-minute break and move to introducing you guys to our audience spotlight, because this kid will literally blow your mind. So Dave, you get a 5-minute break, and we're gonna get on here John Eringman. Hi, John. I'm gonna add you here.
Hey, Leica, how's it going?
Good. So first of all, you have been a guest on the on this meetup, right? You actually attended some of these meetups,
Yep.
and that's how like my team saw you, Drew saw you here, and he said, "Oh my God, John was on our meetup," and I was like, "That's amazing," because I have followed your content for a long time now, and I have just like loved it. John has collectively like what? 1 million, 2 million
It's
followers, something like
yeah,
that.
about 1.4 collectively right now.
1.4 million followers collectively. And John creates content around finances. John, how old are you?
I'm 26.
26. That's old, man.
I know.
But that's incredible because I was gonna have a surprise person like come interview you, but he is on a field trip to go see a self-storage facility here in Boise, Idaho. But I was gonna have Mikey Taylor come here and talk.
Oh,
I
we
know,
love Mikey.
I love Mikey. I just met Mikey for the first time yesterday. We were on a panel together today, and he is such a great guy. So I was talking to him about the meetup, and he asked me to ask you this question.
Yeah.
So before we get into the question, can you give us an overview of what you've been doing, how you were able to build this following, and what kind of content you put out?
Yeah, so just some background on me. So I live in Cincinnati, Ohio, and I actually went to the University of Cincinnati to get a finance degree. And as I was going through school, I started learning about accounting and financial modeling, like all these like kind of high level topics. And I realized that they didn't really teach us finance students about personal finance or student loans or credit cards or any of that stuff. And so I kind of thought in my head that like, if schools aren't teaching finance majors personal finance, then they're not teaching anyone else about personal finance, right? So it just kind of shocked me how, personal finance is not talked about in schools, and it's definitely not talked about in homes, like in your personal households as well. So that kind of fueled the fire in me. And I started making my own financial education content. And I really started on TikTok. That's what was the big, that's what was popping back in, late 2019. And so I got into TikTok. I just started making some videos in my parents' basement, actually. And 2 years later, after consistently making content, I see myself at over 1 million followers. And now it's my full-time job. I'm a full-time content creator, and it's just been amazing, past 2.5 years of financial education and meeting people like you. So it's been fantastic.
Well, thank you for that. So tell me, when you say you're a full-time content creator, do you get paid for the content you put out? Is that
Yeah.
is that an income producing?
Yeah. I mean, it's my full-time job. So there's a few different ways that content creators can make money.
Yeah.
Most of my income comes through like sponsorships. So if I were to say, hey, this is how you invest, and this is the investing app that I use, they might pay me to recommend their investing app. Obviously, I only want to work with companies that I actually use and enjoy using it. So sponsorships is a big one. Affiliates is another big one. So think about if I say, hey, maybe you should, if you're interested, use this credit card, and if you use my sign up bonus, you'll get some sort of 20% off, for example.
Because you're friends with Erica.
Yeah.
Yes, I've seen you guys collaborate, and I think it's amazing. What's Erica's Instagram handle?
Erica N. Kohlberg, I believe.
Okay. And what kind of content does Erica put out?
She does like hacks, like how to get a free flight or get free hotels, or kind of like weird hacks like that. That's super viral, obviously. So
yeah, because she's like millions of followers on Instagram.
Yeah, it's insane. But yeah, and just think about, it's just the law of large numbers. Like if I get $10 for every person I recommend this product to, and 1,000 people sign up, that can be $10,000, for example. So it's just very, very visible and can be lucrative. So
okay, so I was going to share screen and show you guys some of John's content.
yeah, let's do it.
Now, most people are oblivious to this stuff, but luckily you follow me so you can save some money. First is they have extremely large carts. With a bigger cart, you're psychologically inclined to buy more stuff. Second, all of their most expensive items are right when you walk in the store. This sets the tone for the entire store. After seeing a $1,300 TV, you're more likely to spend an extra $13 on yogurt or milk. Third, none of their aisles are labeled, meaning you have to go down all their aisles to find what you're really looking for. You're more likely to get lost and stumble upon something that you didn't go there for, and you end up buying it anyway. Fourth is their loss leader. These are the things that get you in the door of Costco. Their $5 rotisserie chicken is the perfect example. Costco actually loses money on these items, but again, once you're inside the Costco, you're more likely to buy something else. And lastly, the one we never think about is membership fees. A standard Costco membership is about $60 per year, whereas the exclusive membership is about $120 per year. And what's crazy is that 77% of Costco's profit comes from those membership fees, which means they can give discounts to consumers all year round.
Yay.
Here's 5 things that Costco does to make you spend.
That's amazing.
Yeah, it's just really fun to make those types of videos.
And like, you know, to the point, and just so much information download. It's amazing.
Yeah. I just enjoy doing it so much. And I think that's really like, you know, people see that I enjoy doing it, and I try to be as genuine as possible in my content. I think that's really what helped grow the following as fast as it did. So.
Okay, so here's Mikey's question for you. So I'm in Boise. For those of you that don't know, I'm in Boise for the CRE Circle event. We've had some amazing speakers that I've been on stage with today. We actually had a whole panel for social media, and I did that panel. Like, don't mind me, I barely have 10,000 followers, but I did that panel with Investor Gold Brit, Brandon Turner, and another guy, Dustin, I want to say, who are like literal ninjas. So I don't know why I was there, but it was really fun. So this is what Mikey said. He says that when he looks at all these other investors that have like amazing social media content and great big following, it's all investors that have actually done the work, that have the experience, that are now talking about their experiences and drawing from the past, right? Like, hey, this is what I did, this is what worked for me, and that's why I want to share this with you because it worked. But the way you're creating content is almost as though you are reaching out to people who don't have the experience, but you're like, let's all grow together, you know? Like when I first said, I want to interview you, you said, oh, but I don't own much real estate. And I was like, no, it doesn't matter. You're doing something that is so kick-ass, right? So like, what made you think, yeah, I can do this? Like, I can have that following, I can create amazing videos. What even gave you the idea, like, this is the route that you wanted to go?
Yeah, that's such a great question. And people don't think about that too. But you know, when I was thinking about making content, I felt that imposter syndrome. Like, who am I to tell someone that, oh, you should, you know, pay off these student loans or get this credit card? You do have that imposter syndrome, like when you first start, and it's something that you kind of have to get more comfortable with and get over. But I think what attracts an audience too is kind of going through it together, that journey together that you guys go through. And I know that, you know, when I have a duplex. So when I was house hacking, I was making videos about that duplex. I was still learning myself, but then I was also teaching, you know, thousands of others the mistakes I made and some of the benefits of house hacking and all that. So I think that's what really people gravitate towards, is that, you know, you don't have to be some expert to start making content. You just have to put yourself out there and, you know, have that community around you, because learning together is just the best way of learning. You know, you don't want to learn alone. So, and I think Jacqueline, who's on this call, does a great job of that as well. Just, you know, putting her real estate videos out there, like as she's doing it. So it's just really fun to do. And I enjoy it as well. So.
I love Jackie. Jackie's been coming to the meetup forever now, and she has been such a big supporter. She always like posts about it, and I've seen her following just grow. And I'm like, and you know, the thing that Jackie does, which is so meaningful, is that she doesn't just like someone's post, but she comments and she says something really smart on that post. And because she does that, then people follow her because they see that hers is the top comment or the most liked comment. And then people go and follow her. And it's like, and then of course, she also puts out amazing content. But like sometimes if you don't want to be on camera and you don't want to create content, you can just speak or comment on other people's great posts and say something really smart so that people follow you, because people want to hear from you.
Absolutely. I think, yeah, teaching as you're learning, just, it provides that vulnerability that, people are, they enjoy that, or they like seeing, someone else go through it as well. So.
Yeah. Well, thank you so much for being here and being a part of this event. And I hope you can stay for breakout rooms.
Yeah, I do have to hop off at 6 my time. I don't know what it is your time, but I'm definitely staying until then. I'm excited to hear more about the real estate market. So
we are in 5 different time zones. There's East, West, there's European, there's all kinds of central, everything. So yeah, we'll be here. But
awesome.
Thanks, John.
Thank you so much for having me. I appreciate it.
Absolutely. And soon you're going to have this incredible real estate portfolio, and I'm going to interview you on just how you built that portfolio.
Absolutely. It just takes time. That's for sure.
That's it. Awesome. Bye.
Thanks.
Hi, Dave.
Hi, that was awesome. John, you turned me on to John's content and I've become a very fast fan. So thanks, John.
Hi.
It's super, super cool to see what you do and really appreciate it. And man, that Costco video makes me feel bad about my own spending habits. They get me on absolutely everything.
I feel like you guys are also very similar in the way that you create your content. Is you have, first of all, this amazing way of talking and giving out super intense information, like just in a more digestible manner. And you guys both do that so well that I was like, you have to be friends.
Well, that's great. I would love to be friends, John, but your content is like in a whole other class than mine. But thank you, Leica, for saying that.
Down to be friends, Dave. I love your stuff as well. So
all right, let's do it. Leica, you're just matchmaking right now. Just putting the people together.
Look at that. All right. So I think the most important topic that I keep getting asked, like literally every month, is how do we pick the right markets to invest in? So before we go into the right markets to invest in, what are some factors that you're looking for to be able to even just analyze data around the right markets?
Sure. Yeah. So I try to not make it so complicated. I think that there's just some simple supply and demand logic that you can apply to this idea. If you want to look for markets that are likely to grow in the future, economic growth and population growth, I think, are the simplest way to do that. And of course, there are different data sets and things that you can look at to measure those things.
Dave, hold on 1 second.
Sure.
After this question, I want you to go into what markets to invest in, because my laptop is dying and I have to charge it. So I will be right back.
Okay. Should I keep talking?
Yes.
Okay. Basically, those two factors, I think, it's just logical, right? If people are moving to an area a lot, and that's likely going to see an increase in demand. And if the economy is growing, people's wages are likely to grow, which means that they have more money to put towards either rent or to push up housing prices. So those are the two things I look at. If you want to get a little more sophisticated with it, you can start to look at the supply side of the question, which is how many housing units are there? What is the construction rate in those markets? But I don't think this is like overly complicated. If you think about this, you can probably name the top 20 or 30 markets to invest in the United States, just thinking about it logically. It's places where you hear a lot of growth. Obviously, there are some markets that I think probably have grown faster than is sustainable. Leica might be sitting in one of them right now, but there are.
And we get to why Boise.
But so those are like the basic things. I could get into more detailed things, but just think about supply and demand. Like, where are people going? How fast is the economy growing there? And is there sufficient supply in those markets? So those are generally the criteria that I think are most important. if you are really interested in data analysis like I am, there are things that you can look at, like the diversity of employment. A place to me personally, like Las Vegas, is not very appealing because it is so highly dependent on one industry. I like to look for markets like Denver, for example, or Austin, or Raleigh, are all really good examples of places that have very diversified economies. So if one industry is negatively impacted, it doesn't tank the entire market. Those are sort of some high level, hopefully digestible data sets that you can look at without getting too complicated with it.
Andre is such a great guy. Like, you have to meet Andre. Andre is such a data nerd too. Like, I have to put you guys in touch.
Oh, great. These are my people.
These are your people. Like, Andre's building a website basically Andre, can you unmute or come on the camera and talk about your website?
Hey, yeah, can you hear me?
Yeah, we can hear you.
Thanks for putting me on the spot, Leica. Wasn't
it.
Just in a sentence, I'm trying to build a website that analyzes these markets a lot faster. So basically pulling all these data points in one place. I'm sure, Dave, and what I've experienced is if you want to find these data points, you have to go to 10 different websites and put it all together. I used to build a spreadsheet to do a lot of this. So just consolidating all of that to make it easier.
That's awesome. Do you have other data points that you look for other than what I was just saying?
Yeah, so all the growth metrics, right? Population growth, income growth, rent growth, job growth. I was curious how you measure economic growth, because you said economic. Are you trying to measure like the GDP of like the city, or like how do you kind of define that?
Honestly, mostly wage growth. I think just like the total number of wages, the total average wages and the total number of job openings, for example, unemployment are really good proxies for doing that. NAR actually is a really cool website that's free that compares the number of new jobs created to new construction permits, which is kind of cool because it shows like how supply, new supply and new demand is balanced. So that's pretty cool. Unfortunately, you probably are experiencing this too, Andre. Economic data on like an individual basis doesn't come out as often as I would like. You can see housing market data, how many new listings there are like in near real time. Whereas like the census comes out with the median income in an area once a year, and it's like lags really far behind. So it is kind of hard. And kudos to you, Andre, for trying to figure this out. I would love to look at that. But yeah, it does take some Googling and trying to find some smaller sources than like those big nationally available ones, at least in my experience.
Andre, is the website ready to go now?
It is live. It's still like in beta phase, I guess I'll say.
Okay. Well, if you want to share it, people want to see it. So on the chat, if you want to share it, go for it.
Sure, I can type the link in the chat. It's called lazyboots.io. With the idea being you don't really have boots on the ground, and so.
Oh, I love that.
I do like that. That's fun.
I like that.
Yeah, I appreciate that, Dave. The idea is to try and get more granular data. So now I'm going to be on the hunt for granular economic data. You got me.
I know it's hard. It's hard to come by. Luckily, more and more data becomes available, but this will be cool.
Okay, so going to markets too. What markets have had the least or the most impact on rising rates?
So I think, the Sun Belt has been like what's really exploded over the last couple of years predominantly. And, Florida and Texas being the two most notable states. Arizona, Tennessee, North Carolina have all seen extremely high growth. And that's for a lot of reasons. We actually did a whole episode on the market that just came out on Monday with Taylor Marr from Redfin, who
yes,
does like all of the original research on migration patterns. So it's really interesting. And I learned a lot speaking with him just about what variables are pushing people there. But so those are the markets. We're seeing a lot of out-migration from large, expensive cities like New York and San Francisco, moving towards, of course, Austin, Tampa, Miami, Raleigh, Charlotte, and Boise, of course, are like some of the big winners over the last year or two at least in terms of home prices. But that said, like, of course, like past performance is not an indication of future performance. And so I think it is going to be very interesting to see over the next year or two if markets like, I think Boise is a particularly interesting one, that if these prices can be sustained.
Yeah. When you're looking at basically say Boise or any of these markets, right? Why are sellers like even still selling in this rising rate environment? And I'm not saying that they sell in Boise, but I'm saying that in Boise, they probably will be bought much sooner. But like, why are sellers still selling?
Yeah, it's a good question. And I think generally speaking, there are a lot of factors in life that are non-rational economic decisions. These aren't stocks. This is a place that most people live, and people want to move closer to family. They get sick, they get a new job. There are things that force people to make suboptimal economic decisions if it's right for their lifestyle. And so there's always going to be a certain amount of people who are selling. But I do think we're like close to the bottom of that. Like, I don't think we have a lot of people who are like super pumped to be selling right now, because most people sell with the intention to rebuy, and no one wants to buy right now. And so like, that's why people don't want to sell. So that's why I was saying earlier that I think a likely outcome in the next year or two is a lot of stagnation, as people just kind of like wait to see what happens. And of course, housing sales won't completely halt, but we're seeing the number of sales like really start to decline. And I think that's really likely to keep happening. I don't know if you guys saw just yesterday, Redfin, Compass, better mortgage companies laying people off. It's not necessarily because housing prices are going to go down. It's because the number of houses that are going to be sold is going down. And that is, how brokerages and mortgage companies make their money based on volume, and the volume is really going to go down. So I think we are going to see very few sales. And I think we're also going to start to see, my big question is like, with rising rates, things are not as cheap as they were a few months ago. And it'll be interesting to see if there is migration into these cities where there isn't as big of a natural economic engine. So you look at a city like Boise, it doesn't have the employment base that Austin does, right? Like, people are moving to Austin because Tesla and Panasonic and all these huge companies are committing to that company. Boise, more people are moving there, but it's not, supported in the same economically fundamental way as a place like Charlotte is. There's tons of banks in Charlotte. There's a lot of insurance companies there, like good, strong, recession-resistant employers. So I think there are markets that are Boise, I would call more like a quality of life market. That's not a knock on it. It just doesn't have the same historically strong employment and economic growth. So those are some questions I'm really curious about over the next few years.
So one of our audience members has a great question. With employers calling their workforce back into the office, what do you see, where do you see like Floridians and people that are being called back to like a New York or a San Francisco? Do you see that migration pattern in the next few months, like taking effect?
This is not my area of specialties, but I'll venture a guess and say no. Right now, even though rates are rising, and as I said, like the Fed is trying to, they're not trying to break the economy, but they're saying they're willing to. Basically, there's still 10 million job openings right now. So like the labor market is still extremely strong, and the amount of time it's going to take for rising interest rates to ripple through the economy to the point where labor loses its leverage, I think is going to take a little bit of time. And so if I were a Tesla employee who was getting called back into work and I didn't want to go back to work, I'd just go apply for a job at a different tech company that's going to pay me a shitload of money also. So that's sort of the dynamics. I think that will change over the next year or two, but I think there's still a lot of, the labor market's just so tight. I think that it will take some time for it to loosen to the point where especially high skill workers lose their leverage.
Have you seen like new construction increased, like new home construction increased across the country?
Yeah. So construction, I think, is a really interesting aspect of what's going on right now. And there's this very strange dynamic that does require a bit of nuanced, it's not like data analysis, but just like looking a little bit past headlines shows that the number of new construction permits, which is, people just saying that they want to build something, is up. But the amount of homes that is getting completed is completely flat. So this is largely a reflection of just the supply chain issues and labor shortages right now, is that people want to build homes, they're permitting homes, they're even starting homes in a lot of places, but they just cannot complete them. And so for a while, I think there was this narrative that we're overbuilding because the pace of construction did really pick up over the last few years. And I do think there are probably some markets that are overbuilt, but I think it's going to stop now. We already saw it. I think the last print was for May, and we saw it went down 3% already in 1 month. It's probably going to keep going down because, like, let's be honest, like, who wants to build right now? Like, the market is super uncertain. It's super hard to get materials. It's really hard to get labor. And the inventory, and I think this is a common misconception when people look at real estate data, inventory, like months of supply for new homes, like newly constructed homes, is up. It's like going up pretty rapidly. And so that, to me, would be a concern if I was a builder or if I was someone who is a developer, is that I think demand is really starting to soften for new construction. But just so everyone knows, like, the housing market for new construction and existing homes they're obviously related, but like they're not the same thing. And so we're seeing things that, like, the months of supply, I don't know off the top of my head, I think it's like 9 months now for new construction. But existing homes, I think, is like 2.2 months. So it's like very different dynamics. And for anyone who doesn't know why that matters, months of supply is basically a good measure of like the balance between supply and demand. And typically it's assumed that 6 months is about healthy. Actually, before the pandemic, about 4 months was considered healthy. So you see an existing home sales market, the months of supply is still well below what you would expect, indicating that it's still a strong seller's market, even though demand has dropped off. The new sales market, on the other hand, is indicating that it's not such a great market and that the power is returning to the buyer there. And so I personally think we're going to see construction slow down again, which is probably better for the housing market in the short run, but is probably really bad for the housing market. Not housing market prices, but just like society in the long run, because like we need more houses in the US. That's why prices and rent are going up so much, is because supply on a macro level is likely too low, somewhere to the tune of 2 to 7 million units. And so if construction slows down again, it's unlikely that we're going to reach a point where there's actually affordable housing in the country.
So I was going to talk about rent and rent growth or decline. What is this doing to our rentals?
So rent is pretty stable. Like if you look at rent charts over the last, 30 years, it just goes up. It barely ever goes down. Even during the Great Recession, when housing prices tanked about 20% on average. I think they went down around 4 or 5% in some markets. Some markets went up, some markets, and it didn't go down really in a lot of markets. I forget the national figure off the top of my head, but that is not something I would worry about. Rent is extremely sticky. And I think in a different climate, you could see rent go down, but I don't really see a scenario where rent is going to go down significantly. Like, for that to happen, you would have to have a lot of people choosing to consolidate households, like live with friends or go move in with a colleague or friend or whatever, because yeah, exactly. Because vacancy is at an all-time low. And so it's not like there's like, you could leave an apartment and be like, oh, I'm going to go find a cheaper one. Right. Probably not going to happen, unfortunately, for a lot of people who are renters. So I think from a landlord perspective, in this type of market where there is a lot of market risk, would assume that rents would go down 10% to be super conservative. But I personally don't think that will happen. If you want to be conservative, you might want to bake that into your underwriting.
Yeah, I don't think that'll happen either. Okay, can you talk to us a little bit about finding good data, what real estate trends to follow, and also how to interpret this data that you find? Because not everybody is a data whiz.
Sure, yeah. So I think there's all sorts of great free data sources. The two I recommend the most to people are Redfin. They have a really good, they call it like their data center. It's pretty good. They have a lot of the key information that you should look at here. To me, the most important things to look at right now, I don't want to overwhelm people, but the two data sets I continuously tell people to look at are days on market and active inventory. Because again, those are really good measurements of supply and demand and the balance between them. And right now we are seeing demand drop, but because supply is also low, it's not having the impact that normally would happen with a demand drop. And so could that change? Yeah, like absolutely, it could change. Right. So that's why I keep an eye on that. And I think those are like the metrics to look. I think days on market, active inventory are going to increase. If they increase gradually, my best guess is that we'll start to see a flat market. If they go up like really quickly, then we might see prices start to come down, or generally just some tips for looking at that data. I also like Fred a lot. It's just the Federal Reserve Bank of St. Louis's website. They aggregate a lot of government data and make that very easy to use. So if you wanted to look up new construction permit for a specific city, you could get that for free there. It's not always the most, government data is not always the fastest, sometimes it's a couple months in arrears, but it is still really helpful. So those are the two sites I would check out first if I were you. And then generally speaking, it's very hard to give advice about how to like be a data analyst concisely, but I would say that there's a rhyme that a friend of mine, a great housing market analyst, Logan Motoshami, says all the time. The trend is your friend. And I think that's sort of what you want to look at, and not short-term trends. Look at long-term inventory trends, look at long-term rent trends, look at long-term housing appreciation trends, because right now the reality is, I think the housing market's going to moderate. We're going to see prices plus or minus 10% over the next 2 years. I don't know. But like, I have a high degree of confidence based on data analysis that in 10 years, I will be very happy to have bought real estate at this even period today. Of time. And yeah, even today. But is it going to be my best deal ever? I honestly don't know. It might be a good deal. It might be a below average deal for me. But I believe in like the cost to averaging approach, dollar cost averaging approach to real estate, which is like continuously buy at a consistent pace. And so generally, like, those are the trends that make me feel better. It's like, it's uncertain, but I want to be proactive. And I look at long-term trends and not worry so much about what's going to happen in 6 months. It's hard not to, I admit. I just like everyone else, worry about it. No one wants to buy at the top. But at the end of the day, like, I take solace in knowing that I think there is a good chance that prices don't come down, and that this might be a decent time to buy, one of the better times to buy in the next year or two. That's likely. And either way, even if I see, my property on paper lose value, I know in 10 years, property is going to be worth well more. And in the meantime, I'm going to enjoy the benefits of amortization and tax savings and cash flow and all that. So I'd recommend people just zoom out is probably the best way to describe the way to look at the data.
I really love that. The one thing that I keep telling people is that in 6 months, when your interest rate's going to be at 7%, you would look back and be like, oh, I should have bought 6 months ago when it was only 5.5.
Totally. Yeah.
Yeah. And today I was on a panel with AJ Osborne's dad, Ron Osborne, who is, I want to say, in his 60s. And so he was around when interest rates were 18%. And he's like, what is a 0.75 rate increase? Like, that's nothing. You're not at 18%. You're still at 5-6%. And so I guess perspectives, generally give you a lot more solace.
Totally. Yeah. I think interest rates, like on a historical basis, are definitely, they're getting closer to the historical average, but they're not crazy. Yeah. To me, the interest rates hike is not the absolute number. It's not that it's 7%. It's that it was 3%. And people, it's not about it's not really about the historical perspective. Economics, unfortunately, is a lot about just people's opinion of what's going to happen and their reaction to it. So people are going to react, and it might not be rational. And that means that it's not that you're paying so much interest. That does suck. But I think more importantly, it makes you wonder, just like sort of if the housing market is going to reverse because people are going to get so spooked.
I love that, Dave. That's so much good information. And I know it's a lot to digest. And you probably want to go back and listen to it and hear it again and again till and especially how to analyze trends and like some of the things that Dave spoke on here. Drew, if you can put a link to our YouTube channel, this whole video is going to sit on our YouTube channel. So go check it out in a couple of days. Give us till about Monday to get it on there. And then you can go back and rewatch this. Okay, so we are going to open it up for audience Q&A. Any questions? John, go ahead.
Hey, yeah, so I just had a question. So I bought a house in 2020. It was a duplex, and I got a 3% interest rate, which looks like phenomenal right now. But I'm looking to buy another house soon, and it might be 6 or 7%, for example. But it's gonna I want to house hack it. And eventually it's going to become a full-time rental when I move out of it. Do you see any benefit of paying that off, even though it is a high interest rate, like 7%? Do you see any benefit of paying that off early? Or do you think it doesn't really matter because tenants are going to pay it off anyway?
Yeah, I usually would say no, there's no benefit to it. But right now, I think without knowing the specific details, like the calculus or math with paying it off early is like you could take that money and do something else with it. But like normally you're going to put in an index fund, but like index funds don't look great right now.
Right,
so I think the opportunity cost of paying down your mortgage is low right now. And like I'm not paying off loans, but like when I'm looking at properties right now, I'm considering putting like 40 or 50% down as an example. It's probably just like a smaller version of what you're doing, both because it just protects you and it improves cash flow. Is it going to get me the best IRR ever? No, but like, I think we all have to sort of collectively adjust what we think we can get for returns right now. And if you can get, a 7, 8, 9, 10% return, even if you put more down or completely pay it off, I think that's fine because like you can always refinance it if rates come down. So like normally I would say absolutely not to that question, but in this environment, I'm kind of open to it.
Yeah, no, it's a great point, and it's something that I'm struggling with too. I'm sure other people are, but I appreciate that.
Yeah, of course.
Aubrey.
Hi. So I have a question regarding your expectation for kind of a stagnation of rental or of home price growth. So we already know like all the data is there's like a really short supply of housing. And for the markets that are still having expectations for like population growth and job growth, all of those people moving into those markets are still going to need a place to live. So even if the interest rates are still going up, like I would expect it just to be like maybe instead of looking for a $500,000 house, they might look for a $400,000 house, and those people would just move down a price range instead of just completely disappearing. So like when I look at it, I would expect the prices to continue to appreciate, even if it's just like people are moving down in the price range. Can you explain a little bit more why you're expecting to see the prices flatten out, even if that supply and demand is still off balance?
Sure. Yeah. I mean, it's hard to say because like what I'm trying to describe is on a national level, I think we're not going to see a lot of either growth or declines. The reality is that housing is really local. We've all heard that, and that's true. And in certain markets, prices are still going to go up, and in certain markets, housing markets are probably still going to go down. So if there is a scenario where population is growing in a city and supply is not keeping pace, it is pretty likely that housing prices will keep going up a bit. But I just think affordability is going to price a lot of people out of these higher price homes, like you said. And I think the assumption here, which I don't know if it's true or not, is like, are there lower price homes to buy? Like, are people going to sell their home in a market where the median house price is 500,000? Are people going to sell it for 400,000? Are there enough lower price homes on the market for those people to buy, or are they just going to opt out or choose not to move there? It's really unclear, but I think like your understanding of like the supply and demand is true. But I think the inventory dynamics and like what's necessarily going to enter onto the market and be available for sale is going to be very telling on whether the price keeps going up.
Okay, great. Thank you.
Sure. Thank you.
Abby. Okay. What about Miriam?
Well, I was just commenting on back to the question that John had earlier, which is, do I put more into my house and, get under leverage that way and pay it off, et cetera. And I was just saying, doesn't the impact of inflation being at 8.6% and probably rising also play a factor? Because if you're getting debt cheaper than inflation, you're protecting your cash by keeping it in that mortgage product versus paying it extra off. It's a multifaceted answer, but I just thought inflation should be considered too. As long as interest rates are below inflation, it's not a bad idea to take out debt.
That's definitely true. Yeah, I totally agree with that. I think the issue is if you are maximizing your leverage and there is a market downturn, that's when you can get yourself in trouble.
Yes.
Yeah, I mean, yes. So like if you're looking at the spread between 8.6% inflation, and let's just use a round number and say you had a 7% mortgage, I know it's not that high yet, you would be assumably making 1.6% through like this arbitrage. The question is, like to John's question, like could you just use that cash and earn better than 1.6%? Like if you put that in and could then generate higher level of cash flow at 3 or 4%, that's sort of the math. Like you would choose then to use less leverage.
Prasad.
Hi, Dave. Thanks for the presentation. Lekha, thanks for giving me an opportunity to ask. So a question on these southeast markets, right? Like the rents on these markets have gone up quite a bit in the last 2-3 years, right? Like if you look at Phoenix, the Orlando's, Tampa's, the Nashville's, right? Like it's like all these markets, the rents for a 2-bedroom are like $2,000 to $3,000, right? Almost close to a West Coast market, right? And so how much room do you see in further rent growth in all these markets, right? Right. So this is one question, and the second question is, which class of properties do you see, more rent growth possible, right? Already we're seeing like the C-class properties, the renters are kind of squeezed, right? Like affordability is hitting their wallets quite a bit with the inflation and not pay without much pay rises, right? So, yeah.
Yeah. So one way I like to just measure affordability of rent is called like a rent to income ratio. So basically, most budgeting experts recommend that you spend about 30% of your income on, no more than 30% of income on your shelter. And so if you look at certain markets and it's much higher than that, that's a red flag to me. Maybe rents will go up, but people are going to be squeezed, right? Like I think New Orleans is like the worst in the country. Last time I measured this, it was like 45%. Like that's not good for anyone. Like I don't want to have someone who's so stretched to be living in my apartment that it's like uncomfortably expensive for them. It's going to be a bad situation for everyone. So I try and avoid any situation like that. And you can do that sort of macro analysis and just see if, if the market is under or overpriced by that metric. I think, it really depends. If we go into a job loss recession and people are losing money, I do think that it's going to halt rent growth a bit, but it's still going to go up a little bit. I think we're going to see, I don't think we're going to stagnate in rent growth. I think it's going to go up a little bit over the next few years, just because of inflation, right? Like that's just how inflation works, is pushing prices of almost everything up, rent being one of the major drivers of inflation. But I think like using the rent to income ratio is a good way to at least compare markets against each other for relative affordability.
Got it. Okay. Thank you.
Thank you, Prasad. Okay, we're going to do one more question and then go into breakout rooms. Okay, and I'm going to ask Angel's question. When the market turns, do you refi then?
Yeah, definitely. Yeah, I think that's definitely a strategy I've heard a lot of people talk about recently, is, assuming that rates will go back down, which I do. I don't know when that's going to be, but my general thinking is that when the economy turns, bond yields, this is going to get a little wonky, bond yields will drop. And that brings down mortgage rates. So I do think even if the Fed doesn't cut rates. So I do think that there's a probability of, if and when there is a recession and, the economy is not doing as well, mortgage rates will probably come down. Frankly, if you're waiting for 3% again, I wouldn't hold my breath. I don't think that's ever going to happen again, maybe ever. We're seeing the impact of what happened with ultra low interest rates for super long time, and reflected in this inflation that we're now trying to combat. So I would be super surprised if we see that again, but could it go down into the mid 5s, mid 4s in the next few years? Probably. And I think that's why I see a lot of people opting for adjustable rate mortgages, which can be a good idea. I know a lot of people are opposed to it, but I would just say, if you're going to do that, just look for an arm that adjusts after 5, 7, or 10 years. Don't do like a one that adjusts every year. That's dangerous. But if it adjusts in 7 years, I think pretty good probability that rates will come down at some point in the next 7 years, and you'll be able to refi into a fixed rate term loan at a lower interest rate. Okay, amazing. Dave, thank you so much for being here and talking to us all the way from Amsterdam. You are a rock star. But thank you guys so much for this opportunity. If you have any questions, you can hit me up on BiggerPockets or Instagram. Appreciate your time. Thank you so much, and good night. Thanks. Bye. Bye.